Hello, everyone. Good morning if you're in London and good afternoon to those in Hong Kong. I'm Julia Charlton, a Hong Kong solicitor, and I'm the moderator of today's roundtable. It's a great pleasure to see you all today for what I'm sure will be a lively discussion focusing on listing in London. So today we're going to hear from speakers from the London Stock Exchange, Russell Speechlys, English solicitors, and FinnCap, the leading nomad and broker on the AIM market, before moving to a panel discussion. While listing on the London Stock Exchange is always an interesting topic, this roundtable is particularly timely in view of Lord Hill's recommendations to the British government on rethinking and revamping the London Stock Exchange's listing rules, which could see companies with dual-class share structures or weighted voting rights, which we're very familiar with in Hong Kong, being allowed to list on the premium segment of the London Exchange, the free float requirements being reduced, the SPAC listing rules being relaxed, the prospectus regime being reviewed, and the standard segment of the London Exchange rebranded and remarketed. The London Stock Exchange is, of course, one of the world's oldest stock exchanges, tracing its history back over 200 years and even further back to 1698. Today, London's main market has over 1,100 companies with a combined market cap of £3 trillion. London is also home to the AIM market for smaller, growing companies with over 800 companies currently listed. London is also an important market for Hong Kong, China, and other Asian companies due to the range of benefits that a London listing can potentially provide, which we'll hear more about today. We'll start off the presentation from the London Stock Exchange by Tom Attenborough, who's the head of international business development within primary markets at the London Stock Exchange, a role in which he advises UK and international companies on the process of going public and post-listing. Tom was previously at Citigroup for over 15 years as an MD. Then we'll be hearing from Victoria Younghusband from Russell Speechlys, UK solicitors, and Giles Rolls of FinnCap, the leading nomad and broker on the AIM market. Victoria is a corporate lawyer from Russell Speechlys who's specialised in capital markets work and now has a particular focus on listed investment companies. She's also a Hong Kong solicitor and worked in Hong Kong in the 1990s. She's a non-resident partner of her firm's Hong Kong office and is a member of the City of London Law Society's Primary Markets Liaison Group. Giles is an associate director and is part of the corporate finance team at FinnCap and is also a qualified chartered accountant. So now we'll start with the London Stock Exchange's presentation on accessing global investors through London. Over to you, Tom.
Thank you, Julia, and good morning to those in London, good afternoon to those in Asia, and particularly grateful for you to join us on a Friday afternoon. Hopefully this is a good way, an uplifting way to end your week. I wanted to just give you a short introduction to the London Stock Exchange, recent activity, and also just comment briefly on our markets, which I think hopefully will set up some of the discussion to follow. As Julia said, London Stock Exchange can trace our history back 300 years or so, back to the days of Jonathan's Coffee House in the Square Mile, where trades were put up on bits of paper on the wall, typically around financing international trade. So the technology has clearly improved somewhat since then. We're very much a technology business these days, with all of our trading electronic through the London Stock Exchange platform. But the DNA of the business in terms of attracting international companies to raise capital in London is still as true today as it was back 300 years ago, when some of the early trade missions were being financed through equity back in Jonathan's Coffee House. What does London Stock Exchange look like today? As you can see from the chart here, we are a market capitalization of 5.2 trillion sterling, nearly $7 trillion. We have been very, very active right across the size threshold. So you can see in the bottom left-hand chart that London is a market that caters from the very small right the way through to many, many tens of billions of dollars of market capitalization at the larger end. We've been very active. So just over the last 3 years, we've seen over 125 billion sterling raised in IPOs and follow-ons on our market. And on the bottom right-hand side, we've just reflected on the nature and sector of the companies that have raised capital recently on our market through IPOs. I think sometimes there is a misperception that the London market is all about traditional old economy sectors whereas actually, if you look at the last 6 months, nearly 50% of all IPOs have been in the tech sector by value of proceeds raised. And that is only going to get bigger with the likes of Deliveroo, Parsley Box in the market at the moment and shortly about to close their IPOs. We've been very, very active, as I said, and if you look at London compared to other financial centres, we've been extremely busy. London remains the busiest financial centre for raising capital outside the US and Greater China, and last year saw $65 billion raised on the London market, about 3 times that raised on any other European exchange. So I think for any of you who have any sort of concerns that with Brexit, how's that impacted the London market? You know, this is something that we've been getting used to for now 4.5 years since the original referendum. And the reality is that the direction of travel is still the same. Companies are still using London to get their business done. Even this year, we've seen 20 IPOs already priced on the London market compared to, for example, 4 on Frankfurt or 2 on Euronext Amsterdam. So you can just get a sense for the strength of flow into the London market at the moment, which continues unabated. When thinking about the attractions of the London market to going public, I think we often talk about the international nature of the market, both by the investor base that trades there and the issuers that list alongside you. This slide just talks about the geographic split of investors. I think London sits in a very privileged time zone that bridges east and west, importantly. So we're quite a unique exchange in the sense that less than half of the equity listed on London is actually owned by UK investors. A very substantial piece, over a third, is held by North American investors, largely the US. And there's an increasing volume of our shares that are owned by newer and fast-growing sources of capital, in particular China and the Middle East. So we're a very international exchange in terms of the investor reach that you can get through the London market. And that compares very significantly to the chart on the bottom right-hand side of this slide, which looks at the US markets, which, although very big and deep and liquid, remain almost exclusively domestic markets in terms of the investor base that trades there. Over 85% of all US listed equity is owned by US institutions. So you don't get that same very rounded spread of investors. Equally, the same can be said of issuers. So London has nearly 40% of all the companies on our market, non-UK businesses. So for those of you in Asian businesses thinking, is this the right market for me? You're being good company. It's a very, very international market that you'd be joining. And last year, 6 of the largest 10 IPOs, for example, were non-UK businesses joining our market. We've seen some very significant flagship deals this year. I won't go through all the details here, but some fantastic IPOs that we've seen. Dr. Martens, a very big and well-renowned global brand, raising one of the largest IPOs we've seen on the London market this year. TinyBuild, which is a Seattle-based computer game publishing business that used London as its home, raised over $200 million in its IPO. Fixed Price, the Russian low-cost retailer, again, very significant IPO, raised $1.8 billion, using the London market as its home. So just to give you a flavour of the international nature of the flow that we've seen into the London market this year. We're also very active already in the Asian market. Again, some facts that may not be sort of familiar to you, but we have over 160 companies from the Asia Pacific region more broadly that are listed and traded every day on the London market. And that gives a market capitalization of nearly $2 trillion overall. So actually it's a very substantial part of our business already. And some big businesses there, from Air China to Toyota to Mitsubishi. Samsung, for example, is one of our most liquid GDRs on the London market. So we're already extremely active, right across the region. For those of you with a China focus, again, I think it's not, it's worth saying that China has been a strategic imperative for us at the London Stock Exchange. We've been very busy. We've launched the inaugural Stock Connect program. We've now had 4 issuers come, A-share listed companies on the Shanghai Stock Exchange, listing GDRs in the London market, raising international capital. We have a very significant FTSE index, which has included China A shares, which got sort of celebrated in China and around the world, giving access to investors in the London market through to those indices. We've seen the first offshore RMB bond priced in London. We've seen the first green bond out of China listed in London, the first green covered bond listed in London. So again, we've been a significant access point for Chinese companies and other institutions to raise capital in the London market. And finally, just to reflect very briefly on what is available to you as an issuer. I know this is a topic that's going to be picked up later on, so I won't say too much here. And I won't test your eyesight by trying to get you to read on this now. It's worth bearing in mind, by the way, that you will receive these materials written afterwards. But essentially, for companies thinking about listing on London, we have the main market, the 3 segments on the left, and the AIM market on the right. AIM has been our growth market. It's been operating for 25 years. It's the one global growth market that's really worked sustainably. We've seen over 125 billion sterling raised on AIM alone over that 25-year period. And the main market, which itself has 3 segments, premium, standard, and the high growth segment. Premium and standard are the 2 that are most commonly used, particularly for companies out of the region. The high growth segment is really a segment just for companies from the EEA region. And worth saying that whilst there are some sort of subtle differences to the market segments in terms of expectations, levels of disclosure, levels of corporate governance, premium segment is the segment you would need to go to were you to want to get access to the FTSE UK series. Standard, however, is the market that many of our international issuers have used. It's a bit more, it's an issuer friendly in terms of levels of disclosure and governance, but also, very much puts you within the international peer group that trades on the London market. So I'm conscious that's quite a quick introduction to everything that we're doing, but really just to launch the discussion that will follow with, it's a vibrant market. There are already some great segments on our market that give access to companies of all shapes, sizes, and stages of development. And that is only going to develop further with the Hill Review, which I think, as you'll hear from later on, will make it even more flexible, even more founder-friendly to list in the London market, which others on the panel will be discussing later on. So I'll pause there, and I hope you found that a useful introduction, set the scene for the rest of the discussion.
Thank you, Tom. We're now going to also do a very quick review of what is involved if you're on the if you're doing an IPO in London. So it's the current rules. We will refer a little to the proposed changes, but the real discussion for those will be in the panel. I'm Victoria Younghusband. As Julia said, I'm qualified in Hong Kong as well as London. I'm really looking forward to going back to Hong Kong when the quarantine restrictions are lifted. In the meantime, we're doing a lot of business and virtual. It's very good to be here with you in this virtual way. Giles.
Thank you, Victoria. Hi, I'm Giles Rolls. I work at FinnCap, a leading financial services brokerage in London that provide advice, promote our corporate clients, and ultimately provide them access to capital across all of the London markets and across all sectors as well. And as Victoria said, this year, despite the remote working, it's the London markets are certainly booming and really coming into their own in terms of actually providing access to capital quickly when companies need them.
I thought I'd start with the current rules on eligibility for the official list. That's the main market. 25% free float worldwide, until we left the EU, you had to have 25% free float in the EEA. Free float means that you don't include holders of 5% or more. The Hill Review is proposing that's increased to 10% and that the free float is reduced. You have to list the whole class of shares and they must be freely transferable. There's currently a minimum market cap of 700,000. That's historic. Of course, you'll hear from Giles that actually it's run more than that. And you have to have a prospectus, which is vetted and approved by the FCA, and you have to build that into the timetable. The official list has two segments, as Tom mentioned. You've got a premium listing and a standard listing. The premium is the gold standard. You have to list only equity shares, and you can't list on the premium segment non-voting shares. That may change. There are different segments for commercial companies, which is most of them, closed-ended investment funds, open-ended funds, which are mostly ETFs, and a new category which was introduced for Saudi Aramco, which is a sovereign-controlled commercial company. Just to canter through the qualifications, a 3-year track record for 75% of the business, revenue earnings, a relationship agreement where you've got a controlling shareholder, that is someone with 30% or more, and it's designed to show the business can be run independently. You've got special rules for mineral, property, and scientific research companies, and shareholder approval for large transactions and related party transactions, which in Hong Kong you would call connected transactions. Tom's already mentioned the FTSE indices. I don't know, Giles, if you want to say something here about that.
I think that it's just worth mentioning there are a number of investors and ETFs that track the market's performance, and these indices have certain qualification criteria. But as a corporate, to qualify is hugely beneficial, as these trackers are then required to invest in your company, and it improves that secondary market liquidity, which is something that investors are very keen on. The sort of qualification criteria, it needs to be a sterling quote. You need to be a UK company, or if you're outside the UK, you have to sort of adopt the UK Takeover Code or corporate governance regime. And there are free float liquidity requirements separate to those of the listing rules that need to be met, as well as size requirements. Generally, the sort of minimum to get into the UK small cap indices is around sort of the 115 million market cap area. And actually, just taking that sort of bottom bullet, the sponsor requirement for the premium list, you require a sponsor, which is essentially a financial advisor or corporate broker, who will support your application for eligibility to the FCA. It's a transaction-specific role, so once you're on the market, it's not a retained position. But whenever you sort of undertake a future transaction, there are requirements to appoint a sponsor to deal with the FCA.
I wanted to say a little bit about closed-ended investment funds, which are a large feature of the London market, but not so well known outside of the UK. They are permanent capital vehicles as opposed to open-ended. They have to have a spread of investment risk. So if they are too concentrated in their investments, they have another option, which is the specialist fund segment on the standard list. They mustn't trade themselves, but they can have an investment portfolio of trading companies, as do listed private equity companies, such as 3i. A precise investment policy On governance, the majority of the board must be independent of the investment manager. And as it's a premium listing, again, a sponsor is required. And then there's the standard listing. And the main types are commercial companies or the specialist fund segment. As you may have seen on Tom's slide, it's much less prescriptive. And so you don't need shareholder approval for related party transactions or class transactions. I've said it's used for SPACs or special purpose acquisition companies, but currently the disadvantage is that if a SPAC finds a company to use the money raised, the listing is suspended. That's likely to be changed as a result of the Hill review because all the SPACs are going to the US market at the moment. You don't need a sponsor. The Hut Group was one that recently had a standard listing, and it has dual share classes and control with the founders. The Hill review wants to make the standard listing more attractive and rebadge it.
Victoria, just one thing to sort of say there. On the whilst the standing listing is less prescriptive, a lot of standard listed companies do adopt some of the premium listing rules around related party transactions and the disclosure requirements there. As from an investor point of view, those are the sort of protections they like to have in place. So whilst they may not be required to follow the rules, they often do.
Moving on to AIM, there's no market cap or free float requirement, but Charles,
yeah,
there
isn't a hard and fast rule, but again, there is a requirement, and it's sort of rule of thumb is around 20-25%. There is flexibility there, but again, from an investor point of view, liquidity is a growing requirement in the UK. So it's something that needs to be in place and at a reasonable level.
The main regulator for AIM is AIM regulation, which is part of the London Stock Exchange Group. And there is a specific rule book called AIM Rules for Companies. You need an admission document, not a prospectus, for the IPO, unless you're making an offer to the public. Perhaps I can pass back to Giles for the role of the Nomad.
Yeah, so as mentioned, FinnCap takes on the role of nominated advisor, and unlike the premium list where you have a sponsor purely for the transaction, the nominated advisor is a retained position that is required for the IPO to act as sponsor and to deal with AIM regulation and their sort of review process. Although they don't specifically review the admission document, they do consider the eligibility of the companies coming to market. But that is a retained position, and we work very closely with the corporates to help them navigate the AIM rules and the disclosure requirements, as well as to act as their broker to the market and promote them to shareholders.
Just once you are admitted to the markets, the rules that I've listed here for all segments, they're all subject to the disclosure guidance and transparency rules, which covers such things as when you have to publish your annual reports and your half-yearly reports, and major shareholding disclosures, and some corporate governance regulations, including, for example, that you have to have someone with financial experience on the audit committee. And the effect, there's also EU legislation called the Shareholder Rights Directive, which actually imposes some of the rules onto standard listed companies that effectively level the playing field, if you like, with the premium listing. The AIM rules equally cover reporting and disclosure. An important thing, which I think was quite a surprise to AIM companies when it came in 5 years ago now, was the market abuse regulation, which applies to issues on any regulated market. It requires insider lists and publication of inside information as soon as possible, subject to limited ability to not to disclose, for example, when you're negotiating a deal. But this is really important, and I expect Giles, like us, we quite often have inquiries about, is this inside information, do we have to disclose, can we delay?
Yeah, I think
I don't
that's
know.
point there, and is something that is dealt with between, because that sits between the responsibilities of the nomad under the AIM rules as well as the market abuse rules. So again, importance of having good advisors who you can communicate with regularly and clearly, because that often it's not a clear-cut answer as to whether something should be disclosed or not.
And finally, if you are a UK or Channel Islands company, you're subject to the City Code on takeovers and mergers. Perhaps the point that that sometimes gets forgotten is the mandatory general offer obligation under Rule 9. So if you have more than 29.99%, there's the mandatory offer requirement, and this can cause a problem where you've got major shareholders and they inadvertently breach it. Charles, I don't know if you want to say something about this as well.
Very good point. It's where you do have sort of a controlling shareholder over 30%. There are, that doesn't constrain you from an IPO, but it does. There are requirements to get that any sort of counterparty approved and agreed with the takeover panel in France, and that to be fully disclosed. And then there are rules about whether you can acquire shares or not without making a mandatory offer. Okay, great. I'll just a run through of what an indicative IPO timetable looks like. It's pretty similar whether this is for the main market or for AIM. You're roughly looking at a 3 months time frame. The initial bit is appointing advisors, and you've got your legal advisors, you've got your reporting accountants, and you've got your nominated advisor in the case of AIM, or your sponsor and financial advisor in the case of the main market or premium list. The sort of main driver of that sort of timetable is getting the historic track record audited, and if it's not already in IFRS, converted into IFRS, which can take a bit of time and throw a bit of hiccups up with when it comes to sort of reporting, sort of accounting policies and making sure those are right. Alongside that, you've got the due diligence as well, both legal, financial and commercial due diligence. And all of this is to support what will go into the prospectus or emission document, which is essentially the document that outlines the investment proposition, highlights the risks in relation to the investment, puts in the historic track record in terms of historic financial information. And alongside that, you've also got a research analyst note and the sort of presentation that will be taken on the roadshow. The roadshow it's normally a 2 to 3 week process of meeting investors, pitching the idea in a 45-minute presentation before you get to sort of book build and pricing. One other sort of important difference between AIM and the main market to mention is the prospectus needs to be reviewed by the FCA, and that is a sort of fixed timeline process that normally takes 4 weeks and is quite front-end loaded. So you need to get the prospectus in relatively good shape relatively quickly. So that timetable of 3 months may be slightly extended where you're dealing with an overseas business, and just in terms of time constraints. This is just to touch on the corporate governance landscape. The UK Corporate Governance Code applies to the main market on the premium listed companies. And I think the main thing to mention here is board composition. You need to have a majority of independent directors. And if you're an overseas business, it's very important to have UK presence from an investor perspective and also for control of the business. As a publicly traded business, you need to be able to react in real time to price movements as they happen in the UK market. And where you're on the other side of the world, that is something that needs to be sort of juggled. And therefore, having boots on the ground in the UK is important. For the AIM market, it's a slightly lighter regime, the QCA code, which is slightly more principles-based and with a bit more flexibility. But with investors, this is an ever greater, they're taking ever greater interest in the governance of companies. So the requirements are growing. On ESG, Victoria, do you want to mention sort of what's happening there?
Yeah, sure. As of next year, premium listed companies, UK registered ones, will have to, commercial companies, will have to report initially on a comply and explain basis on whether or not they've complied with the recommendations of the TCFD, which is the Task Force for Climate-Related Disclosure. And this applies for accounting periods from 1st of January of this year. And the UK government has just Wednesday, announced further requirements for UK registered companies that are listed on ESG disclosure. I should also mention that the stock exchange has now got a green economy mark, and some companies, it certainly helps, I think, if you're coming to listing, to be able to say you've got a green economy mark. That is where I think 50% or more of your products or your services assist the green economy. So, Charles, with the proxy voting agents.
Yeah, so and I think from the investor, just touching back onto the investor side, there are a number of proxy voting agencies that give recommendations to shareholders to vote on resolutions that are put to them. And they look very closely at how compliant the company is with its corporate governance code. And they do give recommendations to vote against, which can be sort of problematic in terms of when you've got directors being re-elected on an annual basis, remuneration policies, audited accounts, all going to shareholders, as well as preemptive rights to issue shares and actually grow your company. So it is very important to get right. So UK investors, Tom touched on the UK market and the depth of capital, as well as a wide-ranging types of investors, from institutional wealth managers and an ever-increasing retail investor base with the sort of advent of the platforms and the freedom to be able to invest. And this is something that is looking to change as well under the sort of following the recommendations of the Lord Hill review. But what are investors looking for? It normally starts with a great leadership team, a strong track record, then a management team that are aligned with shareholders, and as previously mentioned, strong corporate governance. There needs to be, a growth opportunity that is easily understood and gives the, generally it's an acquisitive business for a roll up, or there's the possibility to grow quickly organically. And that clear equity story is very important. Investors in the UK are generally generalist investors, and so they don't have sort of the depth of knowledge. So the story needs to be condensed into a simple story that can be quickly understood. And I mentioned earlier the roadshow. Investor meetings tend to be an hour long, 45 minutes long, where it's a sort of half-hour presentation and a bit of Q&A. They'll do some due diligence, but it is very much on that meeting. So again, back to a strong leadership team and a clear equity story are being vital. Businesses will report against, or the analysts will put guidance into the market. and that is what a company is judged against. So a business that has good earnings visibility and is able to put forecasts into the market that they are reliably able to hit or exceed tend to get the better ratings. Industry dynamics are key, and obviously COVID has shown where some businesses are resilient to the sort of the outtake of the pandemic, and it's important that they're hitting the market at the right time. And we've touched on ESG. That's an ever increasing focus in investors' minds. So timing is important, and making sure that your industry dynamics are favourable. We've spoken about free float, size and liquidity are important. Generally, for an IPO on AIM, realistically, you need to be at around the 50 million market cap size, and for the main market, sort of 100 million plus as a broad rule of thumb. I mean, that it's not set in stone and every company is different, but that gives you an idea. So will UK investors invest in Chinese companies? There's important considerations, legal jurisdiction and regulatory environment for whatever the company might be imposed on, the country and political risk, any sort of tax regimes that all need to be sort of thought out at an early stage. Generally, where companies are overseas, it is depending on what returns are like from UK listed businesses. That's the competition. So there may be a little bit of a premium in terms of returns that are expected, or that investors will expect, given the sort of increased country risk or overseas jurisdictional risks that might be in place. Fund managers are looking for appropriate investment opportunities that they can justify to their investors. And I think an important question to be able to answer up front is, if you're raising money from the UK capital markets and not at home, why are you doing that? And there needs to be a sort of sensible answer to that question, which I think is an important one to answer up front. And finally, there are plenty of advisors, sponsors, brokers, lawyers out there who all advise lots of companies on the market, who are all willing to have an early conversation to discuss. And I can recommend FinnCap and Russell Speechlys as a great first point of call to have a conversation. I would be delighted to speak to you. Victoria, do you want to add anything?
Well, thank you, Giles. Absolutely. Please do get in touch. We'd be delighted to help. And I think we should move on to the panel.
Thank you so much, Tom, Giles and Victoria, for those excellent overviews. So now we're moving on to our panel discussion, where the panelists will answer your questions. And on the panel, we have Victoria and Giles, who you already know. John Edwards, the head of APAC Business Development in the Primary Markets team at the London Stock Exchange. John is normally based in the London Exchange's Beijing office, and he's been with the London Exchange since 2003. And we also have Andrew Collins, a corporate partner at Russell Speechlys. Andrew acts for listed companies on the main market and AIM, and his work includes flotations, fundraisings, and takeovers. He also sits on a number of technical committees for the Quoted Companies Alliance. So let's have a look at the questions. So here, there's a couple of questions about the Hill review. Andrew, perhaps you could answer this one. What is the recently announced Lord Hill listings review, and what are its main recommendations? And then, John, perhaps you can follow up with the next one, which is, how will the Hill review affect the attractiveness of London's market? So, Andrew, perhaps you could give us this quick overview.
Sure. Thank you very much, Julia. So Lord Hill was asked to review the markets in London, really looking to see how competitive they are and to try and improve the UK's competitive position. So he's come up with a series of recommendations, which is a mixture of both the immediate and longer term steps, and with some specific suggestions as to how best to strengthen the UK capital markets going forward. And it's really an opportunity post-Brexit to improve London's standing as one of the world's leading financial centres. So following his recommendations, this will lead to a consultation paper in the summer, and hopefully with the new rules coming in towards the end of the year. And as we've heard, there are a whole range of recommendations from Lord Hill on free float, on special purpose acquisition companies, on the dual class share structures, repositioning the standard list segment and so on. I mean, some of it is quite complicated, but we think it's very good news. It's been well received in the market, and we look forward to his recommendations being brought into place in the rules.
Thanks, Andrew. And John, how do you think it would affect the attractiveness of the London market if this is implemented?
I mean, I think, of course, it's always useful to have these innovations and continue to look at ways we can improve the market. I think it's also worth recognizing that currently, I think we're in a good position already. If you look at the advantages of the London market compared to, let's say, the US market, there are certain areas where we're already pretty strong. For example, in the area of price discovery, the ability to test the waters. It's used a lot more in London, which allows you to avoid these huge IPO pops that you see in the US, where you're leaving a lot of money on the table. Not to mention, of course, the costs, not just the underwriting costs, but also the litigation costs, the ongoing costs. Those are quite significant. And then, of course, there are certain things that aren't well recognized, let's say, in the Chinese market, and I've been working there for the last 6 or 7 years, is that you can do a lot of things already. For example, dual class voting structures on the standard. And Tom already mentioned some of the examples. There's THG. There's some that are currently preparing as well. I think Deliveroo was mentioned. So there's already this ability to do that on the standard market. THG raised close to $2 billion. So already showing you that on the standard market, you can get access, very good capital markets access.
Thank you very much. So just a question from me. When you mentioned price discovery being better, that's sort of in favor of the issuer, right?
Absolutely. I mean, in terms of the issuer, it's and the process of running the IPO, it's going to be very important for the issuer that things be priced right. I'm going to defer it, of course, to FinnCap, since they're on the line on this process. They can probably get into a lot more detail, but it's not insignificant. If you look at the comparison between the two markets, there's a huge difference. You see a lot of money left on the table, and a lot of the IPOs run out of the US.
Yeah, I'd add absolutely the ability to test market, and actually the advent of all this remote working means that you can get in front of investors very quickly and test the market at a very early stage of the process to get an idea, one, of whether there is the interest, and two, hopefully, pick up a couple of cornerstone investors.
Thanks, Giles. And Giles, a question for you. What kind of companies in terms of sectors and industries do you expect to see listing in London this year, or thinking about listing in London this year and coming years?
Yeah, I think it's definitely ESG is becoming an ever greater consideration in investors' minds. Certainly with the sort of lot of young investors coming through. So I think having an angle there is going to be an advantage. I also think there have been, obviously, COVID has brought about quite big differences in terms of businesses that are able to sort of adapt quickly, and certainly real estate businesses, prime real estate businesses in London are maybe struggling. They may well come back, but I think those sort of risks and uncertainties will be trickier. But where there are businesses that are able to benefit from this new world that we all live in, they will thrive. We had an IPO that's going live on the 31st of March, Parsley Box, which is a consumer business, and able to access their underlying customers very easily in the current market.
Thank you. Thanks very much. So, Victoria, I think this question you could answer, and perhaps John would like to comment on this as well. Victoria, are Chinese companies able to list directly on the London Stock Exchange, or do they need to list the shares of an offshore holding company? And can the shares of overseas companies be traded through Crest, the clearing system?
Thank you, Julia. The first point, in practice, it's much easier to list a new holding company, which is either UK or Channel Islands. It helps, amongst other things, for the FTSE indices that we talked about earlier. But it is possible to list an overseas company either through global depository receipts or to list their shares. But for Crest, you can only have shares in Crest if you're a company that's incorporated in the UK or the Channel Islands or Ireland. Otherwise, there's Crest depository interests, which are not, they're not the same as GDRs, but they are similar. They're basically, that they're directly linked to the shares.
John,
So,
would you like
for example, I have with clients with Crest depository interests, and they're common for European companies as well.
John, would you like to
Sorry,
comment
John,
on that?
did you want to?
Yeah, no, I think that's absolutely right. There's the important thing is that there is a way, whether it be through holding companies or whether it be through the use of the DI, if a company is using a Cayman structure, and so often that is the case where you see the Hong Kong Cayman structure being used, and you can put this DI wrapper around the Cayman shares and list that. Currently, you don't have that for the HK for HK listed or HK incorporated. But if you talk to Link or ComputerShare, that you can have that discussion. The important thing is settlement and liquidity and trading. So there are ways to address that in working with your legal counselors, and I think it's also incumbent upon the issuer itself to do as many roadshows as possible to support that liquidity into the market. So that question, I see that question really about how can we facilitate and ensure that companies that list in London trade well. And we have those instruments, and we have those mechanisms, including the Shanghai-London Stock Connect, which Tom mentioned in his opening remarks. That's another way. It's the GDR, Global Depository Receipt, which is well understood by the market and investors. Again, it's another instrument which investors are comfortable with in investing in China stories.
Thank you. Thanks. And here's another question, I think perhaps for you, Giles. How long does it normally take to list a company on the London Stock Exchange from preparation stage to listing? I mean, that's the question. I mean, we did hear about the timetable, but I suppose, is that really realistic? How long would it normally take for a company from when they start preparing?
Yeah, it's a good question. And I think the key thing is how well prepared the business is already in terms of its reporting structure, its processes, it's that historical financial information. If you've got that prepared and ready to go, the process can be very quick. And within this remote world, you can do it very quickly. It could be less than 3 months. We did one over the summer, Phonics Mobile, which we did in 2 months from the decision to go to actually getting it on market. It can be considerably longer than that if you have any issues with your HFI, or if it's a complicated historical period where there have been maybe multiple acquisitions that need to be looked at, whether a sort of pro forma financial statements is required. So I think the important thing there is to engage early with advisors, so that any sort of structuring points on the legal side, or any governance points, or anything to help with the equity story can be addressed early. And then once the decision to go is taken, maybe post the test marketing, as John mentioned, it can be done quickly.
Thanks. And I think it's another question here, perhaps for you as well, Giles. How attractive is the London Stock Exchange for family businesses? And just to interpret that from a Hong Kong perspective myself, obviously a lot of businesses in Hong Kong may be family owned. A lot of them are, the controlling shareholder will continue to hold more than 50% post-listing.
I think definitely if you compare it to sort of private equity versus public, you have a lot more control, whilst you've got a large investor base that you have to report to, twice a year after your results and other sort of engagements. They are generally supportive. They're there when you need the money, and you're allowed to sort of get on and run your business. There are, if it is a controlling family shareholder of over sort of 30%, then you do need to have in place sort of governance things to support you, like a relationship agreement to manage that relationship. And also there are takeover code requirements that Victoria mentioned earlier.
So in short, that would be fine for family business to list.
Absolutely, yeah. In short, it's not a problem. There are things we manage. Sorry, we've got the family running.
Just to add to that. Just to add to that, Julia, I would say yes, there are, particularly on AIM, there are a lot of family businesses where the family and maybe the founder continues to keep a very large stake in the company, subject to all the protections on that Charles was mentioning. But even on the main market, there are very significant companies where there is still a strong family interest and affinity.
Thank you, thanks. And Andrew, here's another question which I think might suit you. What are the proposals actually for the free float?
Thanks, Julia. Well, we heard a little bit about this earlier. So with Lord Hill, the idea is to reassess the free float requirements by lowering the absolute requirement from 25% to 15%. On the basis that the current threshold is perceived to be deterring companies from listing in London. So that would allow companies of different market caps to use alternative measures to demonstrate that there will be sufficient liquidity in their shares following the listing.
Thank you, thanks. Here's another one which I think Giles, perhaps, and John would like to comment on. What's the minimum or typical size of revenue or EBITDA which makes listing on AIM realistic? Are nomads involved in the book running, or do the companies need to first seek sufficient cornerstone investors before initiating the process in practice?
Shall I start off with that on the first one? Just in terms of, it is very much sector dependent. If you're a life sciences business, then no revenue would be sort of required necessarily if people are investing in the technology. For software businesses, you can probably, if you can demonstrate some commercial traction where you're going to get quite quickly to a decent recurring revenue in the first year, you can look at AIM. It is quite early, but it is possible. So it is sector dependent, but generally, investors are going to want to know that there is a proven track record, either through management or in the existing company. John, I don't know if there's anything.
Well, just to underscore Giles' point about it being sector dependent, looking at the health sciences sector, one example springs to mind, and that's Renalytics, which listed in November 2018 at a market cap of just over $80 million with no revenue. It still has no revenue today, but will probably be on the balance have revenue in the next quarter or so. But that's a company which is now sitting at a market capitalization of just under $1 billion. So yeah, it is sector dependent, but investors have the ability to look into the specifics of the company. In this particular case, it's a diagnostics company for kidney illnesses, so it's the potential of that sector and that technology is so enormous that it's garnering investor attention.
Just the second part of your question in regard to the cornerstone investors, you don't need to have those lined up. Helpful if you do, but that is something that a broker would sort of help to get in place early on through a test marketing or phase one marketing before going sort of deep into the IPO process.
Thank you. Thanks. So, John, another question for you, perhaps. Lord Hill's assessment of the current competitive position of the London Exchange seems less than positive. What do you think about this? And how quickly do you think the London Exchange would get back on track, assuming the recommendations are implemented?
Well, as I mentioned earlier in my comments, I think we are on track. I think it's more of a matter of fine-tuning in specific areas. So we've touched upon that in terms of the free float requirements, dual class voting, and of course SPACs. So I think these are all areas that have been flagged by the market. So we're going to be looking to see those recommendations as they play out over the summer. But I have to say again, just to reiterate, we're in a good position now. I think I'm very grateful for this webinar to help get some of these messages out, that there is already a lot of flexibility baked into this market, and that was clear in Giles' presentation, Victoria's comments earlier. So I think that's the point I'd like to leave that question on.
Yes, I just wanted to say that the FCA, which is the regulator, is very keen. I deal with them on the primary market liaison group, and they are very keen to encourage the market. So you've got regulators who are very much on side if you come to the UK.
That's great. So I now have one final question to each of you. In your view, what 3 words best describe the London public markets? So first, Victoria, how would you answer this?
Expertise. There's a great wealth of expertise amongst all the advisors and the regulators. Regulation. We talked about restricting regulation, but it's good regulation and it's effective. And international. And I looked up what 3 words for those words, and actually I couldn't find a location, but it has to be London.
Great. John, do you have 3 words?
Trust, international, and innovation.
Thank you. Andrew, how about you?
I would say choice. We've already heard that there are a lot of choice of markets, choice of advisors, choice of investors, and choice for investors as well. Innovation's been mentioned, but I would say that there's a lot of knowledge and a lot of entrepreneurism in London. And finally, I'd say welcoming. We're friendly, we're here, London's open for business, and we'd love to see you.
Thanks. And finally, Giles, what would your 3 words be?
I'm running out of words. No, access to a broader range of capital, as we've touched on. Flexibility, as John's mentioned, within the sort of regulatory environment and the different market segments. And for me, above all, credibility.
Fantastic. Thank you. Thanks so much. So that brings us to the end of the roundtable discussion. I hope you enjoyed hearing the insights from our panelists and speakers, and you feel excited and inspired by this roundtable. If we didn't get to your questions, we'll do our best to respond following the roundtable. And if you have further questions, please do email us at the email addresses on this slide. So to conclude from me, it's very clear from today's roundtable that the London Exchange is not only a wonderful exchange right now, but it's also poised for quite considerable reform in the near future, which should increase its attractiveness even further to Hong Kong, China, and Asian companies seeking listing. So many thanks to you all for joining and for your interesting questions. Have a great weekend.